Greenbuild hosts the largest annual event for green building professionals worldwide. Attendees learn and source solutions to improve resilience, sustainability, and quality of life in our buildings, cities, and communities. In 2022, Greenbuild is taking place in San Francisco, California, and celebrating its 20th anniversary.
Hi, everyone. Welcome back to ESG Decoded. I'm your host, Kaitlyn Allen, and today I have Bill Page with me of Essex Investments. Bill, we're so excited to have you. You talk a lot on the circuit. I know you're recently on Bloomberg. It's just an honor to have you on the podcast.
Thank you so much for having me, Kaitlyn.
Yeah. And Bill has just an incredible background here. I'll tell you a little bit about it before we get started. Bill's a co-portfolio manager for Essex's Global Environmental Opportunities Strategy, or GEOS. You're going to hear us say GEOS a lot, so remember that. Prior to joining Essex in 2009, Bill spent 11 years at State Street Global Advisors, most recently as lead portfolio manager for the GEOS and head of environmental, social, and governance investment team. He developed the GEOS over a 4-year period at State Street and was a member of the Global Fundamental Strategies Group. I'm going to just pause there because we have so much to get to. You obviously have a very illustrious career, and we just can't wait to hear more about it. So let's start with what you're working on today. Tell us about the firm and what you do.
Thanks, Kaitlyn. Yes, so I'm based in Boston, and I work on a team. It's an investment management team. We're all focused on running global equities, and it's Essex Investment Management. And so we are based in Boston and Chicago, right outside of Chicago in Evanston, Illinois. And our focus is long-only equity investing, so public equity investing, stock investing, with a global focus. And as a firm, we invest in anything that's disruptive. So we have significant exposure as a firm to healthcare, life sciences, technology. And then my partner, Rob Uick, and I are focused on clean energy, clean technology investing. And so we joined Essex 14 years ago when I left State Street to really bring Essex and focus them and have an expertise in clean energy, clean technology. And as a firm, we're a boutique, as they say. So we're under 18 people. We're running about 800 million US. And then our GEOS focus, it's separate accounts, and we're running about 100 million US for GEOS in a mutual fund. It's called the Pear Tree Essex Environmental Opportunities Fund. So we sub-advise a mutual fund also. It's been a long haul in the clean tech world. I started this approach back in the early 2000s when I was at State Street, and back in 2009 we took it to Essex.
Fantastic. Yeah. And I think, for our listeners to know, I originally saw Bill speak in Houston at a responsible investing conference, and hearing about your journey, your professional journey, was just so fascinating. I'd love to hear you bring that story to our audience as well.
Great, yeah. Being in Houston was really great. We have a long-standing client in Houston, Chris Knapp and RS Capital. And what's great about being in Houston is that you're in the world's energy hub. And so this gets to why I'm doing what I'm doing. And the energy hub in Houston has obviously been based for the last 100 plus years on extraction of oil and fossil fuel power our economy. And what's interesting is there's a lot of dynamic work that's being done in Houston on the new energy economy. So companies like Schlumberger, companies like Sonova. Sonova is founded by ex-fossil fuel folks, right? So the people that I'm meeting in Houston really want Houston, and I think it's becoming a new energy hub and new energy capital. And that's what a lot of these companies are doing. So my journey, I worked when I was in business school as an intern for a company called Kinder Leidenberg and Dominy, KLD. Amy Dominy, Steve Leitberg, Peter Kinder were literally almost the founders, it's not a stretch to say, of SRI investing. And so I worked with Steve Leidenberg on 2 projects when I was at Babson College, getting my MBA, and that experience has sort of been a benefit. Sometimes it's haunted me a bit, but it's been a benefit. So SRI is socially responsible investment. And what was interesting about that is that everywhere I went, I worked at Wellington Management Company here in Boston. I worked at Fidelity and then State Street. My whole career, 32 years, has been focused on SRI because of that experience in business school. And so I sort of lived the full experience of faith-based investors. We still, believe it or not, in the early 90s, we're dealing with South Africa divestment. And then in later on, the late 1990s and into the 2000s, the larger buy-side firms, so these are the large investment management firms, were exploring what was then termed in the early 2000s ESG, environmental, social, and governance. Everyone has their own definition of what these terms mean. And as I think if you asked any large cap manager what GARP means, growth or reasonable price, he or she would always have a different definition. So I think ESG, is it a bit confusing? It's no more confusing than any other aspect of the financial market. So I just think about it as
Love that.
having a reflection of your values, how you want to assess, and having a personal imprint into how you build a portfolio of securities. And the beauty of ESG investing is that you can have exposure across all asset classes today. So ESG does get a little data centric because of the fact that a lot of the firms, including the one I worked for at State Street, we were running analytics and algorithms trying to figure out, is there an ESG factor, or how do you look at a security? And many of the firms that, again, this is my opinion, that were working on ESG data tended to be quantitative firms. So they're working on algorithms to solve for alpha, build, and we could have a whole nother podcast on that. But my background, a little bit on the quantitative side, but I've always been about the old Peter Lynch go out, kick the tires analogy. So fundamental bottom up investing. So in when I was at State Street, I was asked after our former head at ESG left by our CIO in London to take over the ESG effort for the firm, and he got it because everyone in London was about a decade ahead of North America on what carbon was. You think about externalities and climate risk. And so I did that. And as I sort of traveled the world at State Street, I really wanted to go back to what I love. I've always been an environmentalist and try to blend my love of the outdoors and environmentalism with trying to save the world with stock selection. So there's a lot of work that was being done at the time coming out of a number of universities on how do you solve climate. And now I'm into like 2004. This is even pre a lot of the work from the Intergovernmental Panel on Climate Change, IPCC. So some European environmental work out of the UK, and then a lot of work coming out of Princeton and the Yale School of Forestry. Bottom line is that in order to abate carbon, you need to take a broad brush approach. And so I created a thematic approach of 9 themes. And believe it or not, we've done research for the past 2 years to see whether there are any more themes, and there still aren't. So with these 9 themes, you can really solve climate. Now we're into sort of the need for climate mitigation too. So, hardening our economy to the climate change that's already here. So these 9 themes for the Essex Global Environmental Opportunity Strategy, or GEOS, are things like water. There's many industries underwater. We're doing efficient transport. We're doing power technology. We're doing precision ag. We're doing low carbon commerce. And so we have these 9 themes, and we buy the companies that are really saving the world across these 9 themes. I can get more into that, but that's sort of the journey. So what's interesting about clean technology is it has been a volatile area. Well, my partner and I have been researching the space for over 16 years. We have a lot of domain expertise, and now we're starting to see more appetite from asset owners to find companies that are actually have these solutions. Because we're investing in solutions, not just companies that have good ESG ratings.
I think you bring up a really important point, the difference between a thematic fund and sort of a general ESG screen, say, which is often based, like you said, on some sort of rating that somebody it's evolved for a particular purpose. They're often proprietary, they're not sharing the methodology publicly. So I my perception is a lot of the pushback against ESG really is pushing back against the, you know, perceived unfairness or opaqueness of the ESG ratings, and that's actually, completely a different conversation from thematic investing. So, I mean, what do you think? How do you see the difference between thematic and ESG?
Right. It's a really interesting point. And we've got obviously cross currents happening now, for political reasons and sort of pressing down on ESG. You know, there's been way too much coverage, I believe, in the ESG circuit on ESG data. Um, ESG data is financial data, right? That's all it is. And so I've even had the aggregate scores from these SRI firms are aggregate scores. You don't know what's behind them. But these SRI firms, there's very powerful data there, and we have access to the data. We have access to data over Bloomberg. We have access to data for financial models. So we've brought all this into our financial model, right? And ESG is just really a means to evaluate a company with a broader vision you would have if you just were sort of siloed looking at a lot of the sell side research. So what's happened historically in the capital markets is that a lot of these issues, social issues, environmental issues, haven't been evaluated as either a cost or a catalyst to a business model, and that's changing. So the way I define ESG is it's really looking at corporate behavior, and that's really valid. The operating procedures of a corporation, are they factoring in an ESG metric? So we just had a meeting with one of our holdings, and we asked about employee turnover. And this company has a new management team that came in 3 years ago, and they're slowing down that turnover. And when you slow down employee turnover, I believe you can get, ultimately a better margins, profitability, and return on investment. And so ESG is something that we've integrated here at our firm, and we've done it more formally the last few years. We're signatories of the PRIs. We're doing all the ESG heavy lifting. There's no holy grail on ESG data. It's all bottom up, fundamental analysis that we're doing. It's our
Mhm.
proprietary work, our own work. So
I
to
want to just jump
contrast,
in, Bill,
yeah,
sorry, just with PRI, the Principles for Responsible Investment. Just wanted to
okay,
define that. Go ahead. Yeah.
yes, the principles for responsible investment's been around, oh boy, 14 years, and it's a way for asset owners in their asset management firms to collaborate around environmental, social, governance issues and leverage together. So to contrast with thematic, so we're looking at these issues, but we also are investing in companies that in their DNA are companies that have technologies and services that are solving for sustainability. So you could have company X, a widget company, which has a really good ESG rating, doing really good things for their environment. They're controlling their supply chain. They're investing. They're buying all renewables. They're net zero. So they're said we're going to be net zero. So we're going to be you know, carbon neutral by 20. Let's call it 2025. They're doing all the great things. They're investing in LED lighting. They're investing in renewables. They have power purchase agreements for renewables. They're doing great things, and so that's a really good ESG company. What we're doing is we're investing in the renewables companies and the environmental efficient installation companies and the LED lighting companies and EV charging companies the widget companies buying. So GEOS for enabling sustainability. So the other way to think about it is input versus output. So the widget company example is great input. They're controlling their supply chain. Maybe all their suppliers have to recognize emissions. We won't get into the different types of emissions, but their emissions profile. But what our companies are doing is enabling that to happen. So they're LED lighting companies, energy efficiency companies. So that's what we're investing in across these 9 themes. So primarily, our exposure is technology and industrial companies, and we're owning a pretty concentrated portfolio of 35 companies. So GEOS is solutions oriented, so investing in solutions that are solving the world's greatest environmental problems. So, and it's climate, it's centered on climate, but there's so much more than climate. And so when you think about ambient air quality, demographic shifts that are happening globally, the demographic cycle where we need to grow and amplify 50% of our agriculture the next 20 years, right? So these are, and what's happening now with the nexus of things like water, climate, and power is all these issues are getting amplified. So the case for, I believe, our thesis is getting stronger and stronger every day. And then the other value prop is that many of these companies globally, it's roughly the entire world's GDP have signed on to net zero SDG goals. And there's sort of these aspirational goals, but we need to get started yesterday. So what I'm trying to take to market is the fact that these companies are solving all these issues today. And we can get into sort of how do we quantify impact, but we've done a lot of work around the UN Sustainable Development Goals, the SDGs, to exemplify to the market, to our clients and the companies in our portfolios, that the more you talk about the case studies around the SDGs, the more capital we can bring to the market. Because we're not, there was just a report this week from a think tank, we're not moving fast enough. It was actually out of Gates Foundation. We're not moving fast enough on the SDG line.
I have a question for you. So it's so great. I love this when we get into the weeds about differentiating across the spectrum of responsible investing, because, several years back there was, oh, I can't remember, we responded to some SEC proposal or something, and that was when we really at Global Affairs Associates at the time, now ClimeCo, where we really put on paper, hey, this is a continuum, and there's a reason, like, ESG is different from thematic. And the example we used at that time was, if you make a solar panel, sure, that could fit into a thematic fund for clean tech or clean energy. But what if that manufacturing company of solar panels is using slave labor or child labor, and is not, it has very significant safety problems, and et cetera, et cetera. That's not a good that's not a good ESG investment, right? It's not a good, you haven't screened it for ESG risks. So even though it might fit in that theme. So conversely, you just gave kind of a converse example, right? So you have something for a company that fits in your theme. So my question is, do you do an ESG screen on the companies in your thematic fund?
Yeah, it's almost, I would say, common analysis where the answer is yes. We've integrated it. I don't really consider it a
Yeah.
screen. So as we look at these companies de facto, first of all, if you pull up the average cleantech index, sometimes what happens, or let's use our fund as an example, GEOS, and the ticker for the mutual funds GEOSX. You pull up GEOSX, there's no coverage on the ESG firms because we own small and mid cap, and and this gets back to my point on the large buy side firms that were doing a lot of work on the ESG data. All the demand on, and I know that Kaitlyn, this isn't your question, I'll get to your question. All the demand on ESG has been large cap growth in the US, right? And so when you look at mid cap, emerging markets, small cap, credit, there's no data with it. That I don't care at all about that. Actually, we benefit from that because we're doing our own lifting internally. So we've got metrics we use around ESG governance, employee turnover, as we evaluate these companies. But what's interesting too is when you go out and meet the companies, and this is an overused example, but in many cases, it's a really well-positioned company, and they've been touting their solution set, the IP of their company for years, but they've never thought of themselves as an ESG company. I love that because there is no ESG company. There's people using the term ESG stock. I don't know what that means. To me, it's a growth.
Totally.
So there's no such thing as an ESG stock. But yes, indeed, we integrate this. And there's a lot of examples of, from a capital standpoint and a corporate governance standpoint, there's a lot of clean tech companies that are serial destroyers of capital. And the de-SPAC market that we've seen, so SPAC is a special purpose acquisition corporation. There's a lot of SPACs before late 2021. And so we're trying to find the real strong companies that make a good stock. And yet from our universe, they're all companies that are in the new energy economy, one of these 9 themes. And then we do our work, our financial analysis. And in our financial analysis, it's completely integrated with issues like, ESG considerations. Yes. Yep. And then we also, there's no, it's always a long marathon and you're walking the marathon. So, there's no perfect ESG company, right? There's no perfect stock. And so we have our thesis on why we hold the company. And then this is a individual client will meet with their manager on an ongoing basis. We meet with our companies on an ongoing basis. So we want to see improvements in these metrics. And so there's also a term called engagement. Now, engagement in the ESG world tends to be centric to, are you trying to turn around a bad battleship? You know, it's a company that's not doing well and you buy it, and you try to turn it around in a better direction according to ESG factors. We don't do that. We own companies that don't need to be turned around. We believe they're doing the right thing,
That's a
but
smart plan.
they have deficiencies in certain areas of management. So
Yeah.
that's when we engage with them on things like employee turnover or SDG alignment. So the Sustainable Development Goals, there's 17 of them, and we've mapped our companies to these SDGs, and we're challenging our holdings as they write the sustainability reports, not just to talk about input, but to talk about output and solutions. So as they scale their technologies and solutions and services to the industry, how much water, CO2 are they saving for those customers? Now, that's a heavy lift because I don't want it to stamp a stamp from ESG metric firm and say, okay, my work is done. So we're working internally with the management teams to uncover case studies and build up to that overall impact report. But just talking about case studies on output solutions in their sustainability report. So it's not all about how much water we're saving in operations, it's about how much water we're saving for our customers.
Yeah, it sounds right up our alley. It's something it reminds me, you brought it up at the beginning of the call that or earlier, when companies that are they're so good at their product, their technology, their service, whatever it is, that they don't even think of themselves as, a company with a strong ES or G profile or something that they can sell that aspect, that benefit to their customers. So yeah, it's something we've seen and done a lot of work on too with clients, is just helping them to articulate that.
Well, a
Um,
lot of these
and it,
companies don't have internal IR, investor
yeah,
relations.
yeah,
They're small, and so
yeah.
I'd rather. And actually, we just had a meeting with one of our companies, and on the way out, I said we need to work with you on SDG mapping. They said, we've been at the firm for 3 years, and these guys are really good operators since they joined 3 years ago, the CFO and CEO. And the CFO said to me on the way out, you'd rather have us fix the financial footing first. I said, yes. So let's get the firm on really solid footing. It's doing all the right things in the right space. It's mapped, but you can communicate it when you get everything else fixed. We've been in the company for 1 year, but they've been slowly turning the company around. So it's really interesting. And I got a question from a journalist recently on greenwashing. How do we track it? And the way you track it is say do. Right? So what are they telling you versus what are they doing? What are they releasing? And you can't tell if a company's greenwashing. It's going to take you a while, but we're patient, we're long-term holders. But there's been some over-promissory things in the clean tech arena, especially some of the EV electric vehicle companies in the last couple of years, startups, and where they've been way over-promising. So that's a risk. So that's where we go back to the fact, we've been at this in there's 3 clean tech cycles, and we think we're sort of in the second inning, in baseball terms, of the third cycle now. And so these companies are getting a little more mature. But the say-do ratio is really important. So owning a company, publicly traded company, is not just about you know having your own opinion and then revisiting that opinion 6 months later, but continually challenging your thesis. And even these
You just mentioned publicly traded companies, and I know that's what you focus on. I have heard in the past people say, for impact, you really just have to go to private markets. Got to go to private equity, got to go, out of public markets to really have that. It sounds like you don't believe that. I mean, you guys are really focused only on public markets. What would you say to that?
yeah. So there's another term in this arena around and impact investors would say they're not ESG investors, but impact, to me, impact investing is having a very high social impact. And it's sometimes easier, but it's not sometimes, it's very easy to codify impact when you're dealing with a discrete small company or a small investment. And so, family offices are offices obviously by run by high net worth individuals. They generally don't have the reins in the restrictions of a large asset owner like a pension plan, so they can do creative things. So they really led the impact race the last decade plus. And so because of that, the impact circles were a closed system really around, in my opinion, around private equity. And I had a really hard time opening the door around the family offices a decade ago around listed, but that's getting, we've been turned, one client said, you guys are lower social impact than a private, but you peg the dial on impact listed because of, we're investing in the solution. So I think I could, I don't think it's a stretch to say you can have a greater impact listed. Why? Listed markets are more fungible. There's less technology risk, and they're larger cap and they're more global. So why not do both? And so do your discrete, whatever your family office, high net worth individual, vote with your value system across your pocketbook, both on the direct side and the indirect. So I think we're a great completion strategy for a private equity approach. Now, the other thing is the index. And so you're getting my other bugaboo, but that's sort of the case, is that I think they can be complementary. But if you're going to do impact and really think about solutions investing in publics, you got to make sure you know what you own as an investor. To make sure the manager is exhibiting examples around SDG mapping methodologies that can show we're in this for financial return, but we're also in this for solving these environmental problems. And I believe if you solve climate environment, you solve a lot of social issues. So the other issue is just the overexposure of indexing. So we've got a lot of index funds that are out there. The SEC is evaluating a lot of the indices right now, and I think we're very differentiated in the fact we're focusing on thematic. So indexing, if you're an ESG investor, I would say to your investment committee, look at the holdings that are in your index. So you might have low volatility and low beta volatility relative to the benchmark with an index fund, but I don't think it's a high impact solution. And then a lot of the climate indices are focused on, again, climate governance. So how have these companies integrated climate into their operating procedures? They're not focused on the companies that are really solving this issue. So I think I went a little beyond your question.
No, it's fascinating. I think it's wonderful and adds a lot of depth to the conversation on ESG Decoded. So really, really happy that you went all the way there, because I think that's some of these broader themes that folks pick on from outside. It does a disservice to the conversation, I think, because it's so much deeper, right? And I hope if anyone's listened this long to 40 minutes, wherever we are, they know that this is obviously much more complex and deep topic than just a, ESG or no ESG.
And one thing
So
just
that's
came to
really
mind
helpful.
is
Yeah.
I just forgot about my other definition. So impact investing to me is solving for global secular change.
Secular.
Secular.
What do you mean by that? Global secular change.
So by secular change, we've got massive issues happening simultaneously. We've got climate, we have social issues, we have urbanization, we have demographic issues, we have growth in emerging markets. Then there's the climate justice side, where those emerging markets didn't contribute, obviously, in very de minimis ways to the climate. And so impact investing, ambient air quality, water plastics, if you can solve that, to me, that's what impact investing is. And by the way, these are massive, I believe, long-term growth drivers markets. I believe that in clean energy, clean technology, new energy, these themes will get an above market return.
I think it really, I'm just reflecting here on a conversation I seem to be having a lot nowadays, which is we're really rethinking how we make money and how we grow the economy, and make sure everybody's employed and has the job that pays their living wage. we're trying to figure out how to do that in a way that also solves problems, that the problems that you mentioned. And I think it's, I think a lot about the circular economy versus make, take, dispose, the linear economy. And what I think we broadly speaking, humanity, people in business are being asked to do is rethink business models, rethink where we allocate capital so that growth comes from solving these big externalities, solving these big problems, versus just continuing to create new ones, right? So it's sort of an oversimplification of what you're saying. I like global secular change. That's much more catchy. But I think it really is what when people talk about stakeholder capitalism, like that's what it's all about. No one's saying don't make money. No, yes, we want to make money. Of course we want to make money, but how do we do that in a way that is less harmful to the source of all wealth, as the planet, as Patagonia just said yesterday when they gave their company away? How do we do that and think about growth fundamentally in a different way?
Yeah, I think it's becoming so more organic, though. I mean, I'm
Yeah.
58. When I'm interacting, we have a young analyst here at the firm we just hired right out of college, and it's so much more organic. And this is when I used to get interns for the summer 14 years ago. There was only one school, Thunderbird, and then Yale School of Forestry. Now every single university and college, community college, has some sort of environmental finance program, sustainability finance program. So I just think there's been a huge generational step change. And so I used to have to, just think about how far we've come on ESG. The fact that it's in the vernacular so often now speaks to the fact that it's gaining traction. But the folks that are sort of questioning are still sort of my age and older. So I just think it's more organic for younger people that are just simply, it's in their DNA to do the right thing with everything in their aspects. So pretty hopeful about where we're headed.
I love to end on a hopeful note. Let's do that. Let's end on a hopeful note. Bill, this has been absolutely wonderful to have you on, and so glad we got it worked out. Tech issues aside. Do you have any closing thoughts or anything else you want to share?
I do not. I think we've hit everything. Caitlin, great job. Great to be here,
Good.
and best of luck
Yeah.
with the podcast. And we can
Thank
do this
you.
again at some point. I look forward to meeting you
Absolutely.
in person. I'm out in Houston frequently, so not
Cool.
frequently, but twice a year. But you're now in Maryland. But if you come
Yeah,
back to the conference, it'd be great to meet you there.
absolutely.
Thanks again to our sponsor, Greenbuild. Use the promo code DECODED for $50 off at greenbuildexpo.com. See the description for details.